This video is about trading practicalities in futures market. First, I would like to explain about how to start transaction in futures market. Let's say today is March, and in Bursa Malaysia, June crude palm oil futures is priced at RM2,245 ringgit today. So you want to start transaction in futures market, you can take long position or you can start by taking short position. What is long position? Long position means you buy futures contract. For example, today in March, Ahmad buy June crude palm oil futures contract at price RM2245. Or you can start your transaction by taking short position. Short position means you sell futures contract. For example, CT sell June FCPO contract at price RM2245. When you take long position in futures market or you buy futures contract, actually you get a contract where in that contract it states that you agree to buy crude palm oil in June at price RM2245. If you sell June FCPO contract at price RM2245, actually you get a contract where in that contract you agree to sell crude palm oil in June at price RM2245. So basically, when you buy or you sell futures contract, both parties get a futures contract. Okay? So that is how you start your transaction in futures market. Open position. So what is open position? Open position means a trader hold futures contract. That means the trader start transaction in futures market and the trader hold his or her futures contract. For example, if you refer to the previous example, today in March, Ahmad buy June FCPO contract at RM2245. So that is how Ahmad start his transaction in futures market. If Ahmad do nothing in May, that means Ahmad in open position in futures market. That means he's still holding his futures contract. Same goes to City. City in March, he start his position by taking short position or she sell futures contract. So she sell futures contract in March at price 2245. In May, City still hold this position. That means City in open position in futures market. So open position means a trader hold his or her futures contract. Next, we discuss about close out position. So what is close out position? Close out position means you close out or you settle your account in futures market. So you can close out your position by using two methods, offsetting or settlement. The difference between offsetting and settlement is, settlement, you close out at the maturity date. Offsetting, you close out before maturity date. Okay, so offsetting before maturity date, settlement on the maturity date. So we have two types of settlement. The first one is physical settlement. Basically, you exercise the contract. The second one is cash settlement, or basically we say you offsetting at the maturity date. Now we discuss first what is offsetting. So offsetting is you close out before maturity date. For example, in this diagram, okay, you have one futures contract which is June FCPO contract. So June FCPO contract is going to expire in June. Okay, so futures contract is expired based on the contract month. If the contract is June contract, that means the contract is going to expire in June. If the contract is May contract, then the contract is going to expire in May. Alright, so let's say if we refer to the Ahmad example here, so Ahmad in March, he start his transaction in futures market, he take long position. So basically, Ahmad buy June FCPO contract at price RM2245. Okay, so if Ahmad plan to close out before maturity date, Ahmad can use offsetting. So how to use offsetting, or basically how to exercise the offsetting? Ahmad need to take opposite position before maturity date. So in this example, Ahmad start transaction, he used long position. So to close out before maturity date, or basically to offsetting his position, Ahmad need to take short position. So if Ahmad start buy, then close out, he need to sell futures contract. So let's say in May, June FCPO price at RM2305, to close out Ahmad position in futures market, Ahmad need to sell June FCPO contract at current market price in May, which is RM2305. If you refer to the example for CT, CT start transaction in futures market in March, where CT sell June FCPO contract at price RM2245. To close out CT's position, CT needs to take opposite position in May. So offsetting close out before maturity date. So in May, CT needs to take opposite position, which is long position. That means in May, CT need to buy June FCPO contract at price RM2305. So that is offsetting. Offsetting means you take opposite position before maturity date. Now we move to close out position by using cash settlement. So what is cash settlement? Cash settlement, you close out your position by taking opposite position at the maturity date. Or basically, you exercise the offsetting at the maturity date. So if you refer to the example for Ahmad, Ahmad start his position, he take long position by June FCPO contract in March. When it come to June, so June is the expiry date for June FCPO contract. So in June, he choose to use cash settlement. So to use cash settlement, Ahmad need to sell June FCPO contract at price RM2400, which is the price of June FCPO contract in June. For CT's example, CT start his transaction in March. CT sell June FCPO at price 2245 in March. To close out using cash settlement in June, CT need to take long position, or basically CT need to buy June FCPO contract at current market price of June contract in June, which is at RM2400. The second type of settlement is the physical settlement. What is physical settlement? Physical settlement, you exercise the contract by using physical delivery of underlying asset. Okay, we can look at example for Ahmad. Ahmad start his transaction in futures market in March, where Ahmad buy June crude palm oil futures contract at price RM2245. So if you still remember, when Ahmad start in futures, he take long position or he buy futures contract. Basically, Ahmad get a contract where in that contract it state that Ahmad need to buy crude palm oil in June at price RM2245. So if Ahmad plan to close out his position by using physical settlement, that means Ahmad need to exercise the contract. So how to exercise the contract? Ahmad need to buy physical crude palm oil by using crude palm oil futures. So in this example, Ahmad need to buy crude palm oil at price RM2245. The price of crude palm oil is based on the price of futures contract that Ahmad bought in June. So he needs to receive the crude palm oil and pay RM2245. So that is physical settlement for long position. If you take short position, for example in CT example, Okay, CT start his position in futures market in March. CT sell June FCPO contract at price RM2245. So basically, CT get a contract where in that contract it states that CT agreed to sell physical crude palm oil in June at price RM2245. So when it comes to June, if CT plan to close out his position by using physical settlement, CT need to exercise the contract. So how to exercise her contract? CT need to sell crude palm oil using crude palm oil futures. So in this case, CT need to sell physical crude palm oil at price RM2245. So when it comes to June, CT need to deliver the crude palm oil and CT will receive a payment worth RM2245. So that is physical settlement. So to summarize our lecture today, in this video, you learn about how to open your position in futures market. So basically, you can open your position in futures market by taking long position. When we say long position, that means you buy futures contract. Or you can start your transaction in futures market by taking short position. So short position means you sell futures contract. And then the second term is open position. So what is open position? Open position is a condition where trader hold his futures contract. That means the trader is in open position in futures market. Okay. Next, you must understand what is offsetting and settlement. So in futures market, you need to close out your transaction. So you can close out your transaction before maturity date, or you can close out on the maturity date. If you close out before maturity date, that means you use offsetting. If you close out on the maturity date, that means you use settlement. So how to exercise offsetting? Offsetting, you need to take opposite position before maturity date. For example, you start long position. To use offsetting, you need to sell futures contract or you take short position before maturity date. If you start your transaction, you start with short position or you sell futures contract. To close out before maturity date, you must use offsetting. So you must buy futures contract before maturity date. So if you plan to close out on the maturity date, that means you use settlement. So settlement, we have two types of settlement. The first one is physical settlement. The second one is cash settlement. Physical settlement means you use or you exercise the futures contract to buy and sell the underlying asset of futures contract. For cash settlement, you close out by using offsetting at the maturity date. That means you take opposite position on the maturity date. That's all about trading practicalities in futures market. Thank you.